Welcome back to the deep dive. We're here to really dig into a topic, break down a mountain of info into what you actually need to know.
That's the plan.
And today we're plunging into well, let's face it, the often frustrating but maybe ultimately rewarding world of trading psychology.
The big one.
Yeah, it really is. Our mission for this deep dive, it's pretty straightforward. Explore the core ideas of a really renowned trading coach, Mark Douglas.
Mark Douglas.
Yeah.
The disciplined trader, trading in the zone. Seminal stuff.
Exactly. He's been coaching since '82, worked with major hedge funds, floor traders, you name it. And his big message, the core of it.
It's all about the mental game.
Right. Consistent results, he says, don't just come from charts or analysis. They come from a specific mental skill. Basically, learning to trade without fear.
And that, he argues, is the real difference maker
Yeah.
between the pros and, well, everyone else trying to figure it out.
It is.
And what's great here, especially if you're looking to grasp this quickly, is where we're getting this from. We're using actual excerpts from Douglas's own trading psychology seminars.
So not summaries, but his actual words.
Exactly. It's direct access. His wisdom, his stories, the lessons he learned the hard way. So the mission for you, listening in, is clear. We want you to understand how a pro thinks, why that thinking leads to consistency, and crucially, how you can start building those psychological skills yourself.
Right. Regardless of where you are now with trading, it's about that mindset shift.
It really is a transformation.
Okay, so let's unpack the story that really shaped Douglas's whole perspective.
Yep.
He started way back 1978.
Wow, yeah, different era.
Totally. And his very first trade, potato futures, Chicago Merc. They don't even trade those anymore.
Potatoes, okay.
And like so many people, he made money right away and thought, oh my God, this is easy. Why didn't I do this sooner?
The classic beginner's luck trap.
Totally. Went from potatoes to gold, silver. He calls it a typical journey, just, without the fancy tech we have now.
Right.
But then came the trade. The one he says had a profound impact. The reason he basically ended up doing what he did.
Okay, this sounds important.
Yeah. It was 1980, maybe 81. He was long silver.
Yeah.
10,000 ounces at $9.75 an ounce.
Okay, decent position.
And almost immediately the market drops 20 cents. Boom! Down $2,000. So his broker, instead of saying, hey, maybe cut your losses, pushes him into a spread strategy.
The spread. Buying one, selling another.
Yeah.
Betting on the difference.
Complex.
Exotics.
And commissions back then, like $125 per contract round turn. Crazy high.
Whoa.
So Douglas says his broker just kept turning his account. Silver goes up a bit in this range. Broker takes off the short leg, locks in a $2,000 loss for Douglas. Silver drops back. Broker puts the short leg back on, locks in another $2,000 loss.
Oh, man. Just churning for commission.
Exactly. Racked up $6,750 in losses, mostly from the brokers moving things around.
That's brutal.
And the stress. Douglas talks about how he just couldn't sleep. It was eating him alive.
I could only imagine.
So one morning, he just wakes up and thinks, I can't take this. I'm done. Calls the broker, tells him, get out, liquidate the whole damn thing.
Just couldn't handle the pressure anymore. Understandable.
But what happens next? You really need the context of how markets worked back then, these limit-up rules.
Right, yeah. If a commodity like silver jumped by a set amount, say 50 cents.
Trading just stopped for the day.
Halted. And at that limit price, basically nobody was willing to sell.
Yeah.
It's the artificial break the exchanges used.
Exactly. So Douglas gets out.
Oh, no, I think I see where this is going.
And within like 30, 45 minutes, silver goes limit up.
Oof.
Not for one day, for 30 consecutive days. It went all the way up to $49 an ounce.
30 days.
Ah.
Limit up. Wow.
He calculated he missed out on about $400,000 on just those two contracts he liquidated.
$400,000.
And he couldn't get back in. Because on limit up days, you just couldn't buy. There were no sellers. You just had to sit there and watch it go.
That is agonizing. Just pure agony.
He calls it intense agony. And that experience, that powerlessness, it really drove home that first lesson. The market doesn't care about your feelings
Yeah.
at all. And emotional decisions, they just lead to regret.
So thinking about that agony,
Mm-hmm.
what was it about commodity losses specifically that made them feel so much worse than, say, losing on a stock?
That's a great point he makes. With commodities, especially back then, the money was gone from your account. Like at the end of the day, real cash vanished.
Okay, not just a number on a screen.
Exactly. With stocks, often it's paper losses until you actually sell. But commodities, that loss was immediate, tangible. It made the fear, the agony, way more intense. real money walking out the door every day.
Got it. That makes sense. That immediacy.
So that whole silver nightmare, it led him to do something pretty radical.
Right.
He was making good money, like 6 figures, successful insurance agent in Detroit, early 30s, nice life.
Right. Comfortable.
But after that silver thing, he just decided, I have got to figure this trading thing out. So he quits his job, leaves Detroit, moves to Chicago to learn trading.
Whoa. Seriously? Gave up a 6-figure income?
Yep. He said everyone, absolutely everyone, thought he was stark raving out of his mind.
I can imagine. That takes guts. Or maybe desperation after that loss.
Maybe a bit of both. But then he gets to Merrill Lynch, thinking he'll learn from the pros.
Yeah?
Total disillusionment. He realized pretty fast the brokers weren't traders, they were salesmen. Merrill Lynch didn't even teach trading, they actively discouraged it.
Really? What?
Because the unspoken truth in commodities then was all commodity traders are terminal.
Meaning they all blow up eventually.
Pretty much. The average customer account at Merrill, he said, lasted about 6 months before they lost everything. The broker's job wasn't to help them win, it was just...
Distract as much money
Yeah.
as you could
Got it.
until they're gone. Wow.
Yeah, grim. So clearly Merrill wasn't the place to find the answers he was looking for.
Okay, so that's pretty bleak. But somehow, he didn't give up. What shifted?
Well, what's fascinating is, even in that environment, he stumbled upon one of the very first books ever written specifically on trading psychology. It was Jake Bernstein's Investor's Quotient back in 1980.
Ah, Bernstein, yeah, a pioneer in that field.
And that book just clicked for him. He realized really early on that trading wasn't just about charts or news. It was basically psychological in nature.
So that seed was planted early.
Definitely. And it led him to start keeping these incredibly detailed journals, observing his own thoughts, his mistakes, and seeing the exact same patterns in the other brokers, in his customers.
He started becoming a student of the mind, basically. His own and others.
Precisely. And he points out this kind of deceptive simplicity about trading. What's the only physical skill you actually need?
Click a mouse.
That's it. Just moving the mouse, clicking buy or sell. And because it looks so simple,
People think, oh, this must be easy.
right, how hard can it be, leads to a total underestimation of what's really involved.
And that right there, that's the huge psychological gap Douglas talks about, isn't it?
Exactly. He asks, what does it take to have one winning trade?
Like we said, maybe nothing. Pure luck. No skill, no plan, no discipline needed sometimes. Click, boom, winner.
Right. But what does it take to win consistently, to actually generate an income from this?
Ah, well that, he says, requires very sophisticated psychological skills. And most people just completely miss that distinction. They focus only on the analysis, not the mind.
That's the core of it. And the core problem, the thing professionals have figured out how to manage, is fear.
Fear, the big one.
Douglas is emphatic. Virtually every error a trader makes stems from fear. Fear messes with how you perceive what the market is actually telling you.
Okay, so what kind of errors are we talking about?
He lists the classics, the ones pros have moved beyond, things like not defining your risk before you even get in. Why? Because you're operating out of, I think I know what's going to happen next. Ego.
Right, assuming predictability.
Or you do define your risk, but then you don't take the loss when it hits your point. You let it run, hoping it'll come back, which usually leads to bigger losses.
Been there. Done that. It hurts.
Uh-huh. Then there's hesitating. You see your signal, but you doubt it. You wait, get in late, miss the best part of the move.
Or the opposite, jumping the gun. Maybe after a few wins, you feel invincible. Get in too soon before the signal actually confirms.
Yep. Getting out of winning trades way too early, just grabbing small profits because you're scared they'll disappear, leaving money on the table.
Oh, that's a painful one, too. Seeing it run after you got out.
Or letting a winning trade actually turn into a loser because you didn't take profits or manage the stop.
Ugh, the round trip to loser town.
And even things like moving your stop loss closer to your entry point once the trade moves a little in your favor. Then you get stopped out by a small wiggle, only to watch the market rip back in your original direction.
Which, Douglas says, just reveals you never really accepted the initial risk, right?
Yeah.
You were trying to minimize it after the fact.
Yep. Exactly. You were still afraid of the loss you supposedly accepted.
Okay, but here's the tricky part. Any one of those mistakes could still accidentally result in a winning trade sometimes, right?
Absolutely. And that's the insidious danger. You hesitate, get in late, and boom, it takes off anyway. You didn't take the loss, and it did come back this time.
So it reinforces the bad habit. It rewards the wrong behavior.
Precisely. It cements these dysfunctional beliefs and habits. And while you might get lucky on a trade here or there doing that over the long run, Douglas says it sets you up for those catastrophic losses, the account blowups.
Because the underlying fear is still driving the decisions. So where does all this fear actually come from? What's the root?
Douglas breaks it down to what he calls the 4 fundamental fears. Number 1, fear of being wrong hits the ego, right? We hate being wrong.
Yeah, definitely.
Number 2, fear of losing money. Seems obvious, but it taps into deep security issues, sometimes even our sense of identity tied to money.
Makes sense.
3, fear of missing out. FOMO. Seeing others make money, feeling like you have to jump in now or you'll miss the boat. Drives impulsive trades.
FOMO, the trader's curse. And 4.
Fear of not getting the maximum profit, like leaving money on the table. It comes from greed or maybe perfectionism, wanting to squeeze every last tick out of a move.
Okay, those 4 make a lot of sense.
And here's the kicker. He suggests that when you experience just one trading loss, it can emotionally connect to or tap into the accumulated negative energy of every single time you've ever felt wrong or lost something important in your entire life.
Whoa. So one small loss can feel disproportionately huge.
Exactly. Your mind makes these connections automatically. It doesn't distinguish between losing $100 on a trade and, I don't know, feeling rejected years ago. It all gets lumped together in this big pool of negative energy. Makes each trade feel way heavier than it should.
It explains a lot about the intense emotional reactions people have to relatively small market moves.
Yeah.
Okay, so if fear is the problem, and it's rooted so deep, what's the solution Douglas offers?
The solution, and this is really the cornerstone of his whole philosophy, is learning to think in probabilities.
Probabilities. Okay. What does that mean in practice?
It means making a fundamental shift. You have to move away from thinking on a trade-by-trade basis, like expecting this specific trade you're putting on right now has to be a winner.
Which is how most people approach it, right? This setup looks great. This one has to work.
Totally. Instead, you need to adopt a series of trades perspective, thinking about the overall outcome of the next 20, 50, 100 trades based on your edge.
Okay, so how does that help with fear?
He uses the coin flip analogy. Imagine a perfectly weighted coin. If you flip it just a few times, the results are random, right? You could get 3 heads in a row. Doesn't mean the coin is biased.
Right, random short-term distribution.
But if you flip that same coin 1,000 times, a big sample size, what happens?
You're going to get pretty close to 500 heads and 500 tails. The true probability emerges over the long run.
Exactly. And Douglas says that's precisely how a trading methodology, your edge, works. It doesn't guarantee this flip, this trade, will be heads, a winner. But it gives you a statistical edge, maybe 60-40, maybe 70-30, that will play out over a large series of trades.
So the edge is just a higher probability of one thing happening over another over time, not certainty on any single event.
Bingo. And accepting that means accepting that there will be a random distribution between wins and losses for any given edge.
So even with a 70% win rate edge, you could still have 5 losses in a row. That's just part of the random distribution.
Precisely. You don't know which trades will win or lose in advance, just that over the sample size, your edge should produce its expected overall result.
And internalizing that takes the pressure off any single trade needing to be a winner. It diffuses the fear attached to that specific outcome.
That's the goal. It's a profound mental shift, and he says it's absolutely critical for eliminating fear and achieving consistency.
Okay, that makes sense. Thinking probabilistically. Now, you mentioned earlier how the market doesn't care about feelings. Douglas also talks about market dynamics, right? What actually moves prices?
Yeah, he gets into market dynamics and this idea he calls the pebble in a pond effect.
Apple in a pond, okay.
It describes how really big traders, the influential ones, can intentionally create ripples, push prices around, not always just to make a direct profit on that move, but often to manipulate liquidity to build or exit their own huge positions more effectively.
So they're actively making waves, not just reacting.
Exactly. He says prices ultimately move because of conviction. When you, as a passive trader, put in a limit order to buy, your trade only becomes a winner if other people have enough conviction to keep buying at prices higher than yours. Their conviction moves the market through your price.
Okay, so it's the collective belief or the actions of powerful players that drives price.
Right. And he gives some pretty eye-opening examples of these dynamic traders, the ones deliberately moving markets. He talks about hedge funds, big money managers, who will literally bid a market up even if they ultimately want to sell.
Why would they do that? Bid it up to sell.
To create a pool of buyers, they push the price up, trigger buying interest, maybe hit some buy stops above resistance, creating liquidity into which they can then sell their massive position at a better average price.
Creating their own exit liquidity. That explains those false breakouts we sometimes see.
Exactly. Market pops above resistance, sucks in breakout buyers and stops, then reverses hard as the big player unloads.
Sneaky,
Yeah.
but effective for them, I guess.
He even remembers back at Merrill Lynch, they had this squawk box, basically an open phone line to the trading pits. He could hear in real time who the big players were, who was buying, who was selling huge orders.
Wow, inside info.
And he said there was often no correlation between classic technical patterns on the chart and why these big players were actually making their moves. Their reasons were often totally different, related to their larger positions or objectives.
So the pattern might look bullish, but the big seller is just using the rally to get out.
Precisely. He tells other stories, too, like a vice president at Heinhold Commodities publicly hyping hogs and pork bellies on TV, while his firm was quietly taking the other side of all the buy orders coming in from the public.
Ouch. That's blatant manipulation.
Or a big soybean trader he knew, who literally plotted with other large traders how to spank the locals, orchestrate price moves specifically designed to trap smaller retail traders.
Man, that paints a pretty predatory picture of the markets, at least sometimes.
It does highlight that there are players with intentions and power far beyond just following technical signals.
So if you're that passive technical trader, relying on patterns, and these dynamic traders are out there making waves for their own reasons, that seems to explain why you can't really know for sure what happens next on any given trade.
That's exactly Douglas's point. Technical analysis is great for identifying patterns in collective behavior, the what, but it can't read the minds or know the specific objectives of those individual players who have the muscle to cause significant moves, the why.
The map isn't the territory, and the pattern isn't the underlying intention of every single participant.
Perfectly put. Which leads us nicely into another huge area Douglas covers, self-sabotaging beliefs.
Ah, yes. The ways we shoot ourselves in the foot even when we think we're doing well.
He talks about this state of euphoria that traders can get into, especially after a string of wins. It's like a risklessness state of mind. You feel invincible.
Yeah, like you can't lose. The Midas touch.
And what often happens in that state? Let's say you normally trade 1,000 shares. Suddenly you feel this absolute certainty about the next trade. It has to work. So you don't trade 1,000.
You trade 10,000.
Or 20.
Or worse.
Yeah.
You massively increase your size based on emotion, not your plan.
Exactly. Maybe even mortgage the house level of crazy conviction.
Okay, dangerous territory.
And the terrifying part, he explains, is how fast that euphoria can flip. The moment that oversized trade goes against you, even just a little bit, it flips instantly to pure, unadulterated terror.
Because the stakes are suddenly so much higher than you're mentally prepared for.
Right. And this often leads to what he calls mind freeze. You're totally conscious, you see the loss mounting, but you're just frozen, immobilized, can't click the mouse to get out.
Oh, man. Just watching the train wreck happen in slow motion.
Yeah. And that's how those truly catastrophic, account-destroying losses often happen, from that euphoria to terror cycle fueled by improper position sizing.
Makes you think about that common advice. After a big windfall profit, take a break, take a vacation, stop trading for a bit.
Exactly. And Douglas says it's not just about letting the euphoria wear off, it's also because big, unexpected wins can trigger underlying self-sabotaging beliefs.
How so?
Deep down, some people might not actually believe they deserve that kind of money. Maybe cultural conditioning, family beliefs about wealth, whatever.
So even though they made the money, subconsciously they feel uncomfortable or undeserving.
Right, and that can lead them to unconsciously make errors to get rid of it, to bring their account back down to a level that feels more comfortable or deserved according to their hidden beliefs.
Wow, so you could literally snatch defeat from the jaws of victory because of subconscious programming.
Douglas shares some wild anecdotes about this. He coached a bond trader who was consistently profitable, made tons of money, but kept giving it away indirectly, like hiring totally unmotivated people onto his team who then lost the money.
Huh. So the sabotage wasn't in his own trading, but in how he managed the winnings.
Yeah. Another amazing story. A devout Catholic bond trader, also highly successful. But Douglas noticed the guy physically could not put his trading profits in the same pocket as his rosary beads.
Seriously?
Yeah. Douglas realized it was this deep subconscious belief that money is dirty or somehow conflicts with his faith, even though he was brilliant at making it in the pit.
So again, finding ways to get rid of it just out the back door rather than through direct trading of stakes.
Exactly. These stories just hammer home how powerful these underlying beliefs are. Even if you're a trading genius, your subconscious views on money and deservingness can silently wreck your results.
And this isn't just theoretical stuff. Douglas mentions that some big trading firms he worked with took this so seriously.
Oh, yeah, they would literally chart the equity curve of their traders, looking for patterns just like they look for price patterns in the market.
Charting the trader's P&L curve?
Well,
Why?
to predict potential inordinately large drawdowns. They recognized that these drawdowns were often linked to recurring psychological patterns, these self-sabotaging beliefs kicking in. They could almost forecast when a trader was due for a big psychological blowup based on their equity curve patterns.
That is incredible. Treating the trader's psychology as another variable to be charted and managed.
Shows you how critical the mental game is at the highest levels.
Absolutely. So, given all these challenges, fear, market dynamics, self-sabotage, how does Douglas suggest someone actually develop the necessary skills? What's the path?
He outlines the 3 developmental modes of trading. Think of them as stages of learning and mastery.
Okay, what's the first mode?
First up is the mechanical mode. This is where you start. It's all about trading with rigid black and white criteria for defining your edge. No room for subjectivity.
So very rules-based. If X, Y, and Z happen, then buy. If A happens, then exit. Period.
Exactly. All the decisions, entry, exit, risk, are made in advance. The market either meets your precise definition or it doesn't. You just execute.
And the focus here isn't necessarily on making tons of money yet.
No, not primarily. The focus in the mechanical mode is purely on learning the skills of execution and discipline. Can you follow your rules flawlessly without hesitation or second guessing?
That sounds harder than it looks.
Oh, it is. Douglas strongly recommends starting here. And he says if you find you can't execute your mechanical rules flawlessly, you need to reduce your size drastically.
Like even if you normally trade big.
Yeah. Someone used to trading 5,000 shares might need to drop down to trading 10 shares or even just 1 share until they can prove they can follow the rules perfectly over a series of trades.
So take the money pressure off to focus purely on the psychological skill of execution.
Precisely. He also notes paper trading is okay for testing the methodology itself, but you need some real money on the line, even if it's tiny, to actually test and develop your psychology under pressure.
Makes sense.
Right.
Real stakes, even small ones, change the mental game.
Yeah.
Okay, so after mechanical.
Next is the subjective mode. This is more flexible, broader. Here, you're not just relying on rigid rules, but incorporating all your accumulated knowledge, your experience, your understanding of market nuances and patterns.
So you can make adjustments based on what you're seeing.
Yes, but, and this is the crucial distinction, those adjustments are based on your experienced reading of probabilities and patterns, not based on fear or impulse.
Can you give an example?
Sure. Maybe your mechanical rule says hold until your stop is hit, but in subjective mode, you might recognize a specific high probability pattern forming that strongly suggests the market is about to reverse and hit your stop anyway. So you might decide to exit early, not out of fear of losing, but based on your experienced assessment that the odds have significantly shifted against your trade continuing.
Ah, okay. It's using discretion based on knowledge, not emotion.
Exactly. It requires having mastered the basics first.
Got it. And the third mode?
The final, most advanced stage is the intuitive mode. Douglas compares this to achieving a black belt in martial arts.
Okay, sounds lofty.
It is. This is when you're truly in the zone. You have a deep, almost subconscious feel for the market's flow. You might sense shifts or opportunities without being able to fully articulate the rational reasons why in the moment.
Like a sixth sense for the market.
Kind of. But he warns this is only for traders who have completely mastered the fundamental skills in the mechanical and subjective modes. Otherwise, it's way too easy to confuse wishful thinking, hope, or fear with genuine intuition.
Right. You need the foundation first. Otherwise, intuition is just guessing or gambling.
Absolutely. You have to be able to tell the difference.
Okay, mechanical, subjective, intuitive. That's a clear progression. But underlying all of them, the core idea seems to be
that you do not have to know what is going to happen next on a trade-by-trade basis to win consistently.
That's it, isn't it? That's the fundamental belief shift.
He says that is the absolute heart of it for every consistently successful professional trader he's ever worked with, letting go of the need to predict.
Okay. So how does someone actually make that shift? It sounds great, but changing deeply ingrained beliefs is hard. What's the path to change, according to Douglas?
He breaks it down into 4 essential components. First, and maybe most important, desire.
Desire. How so?
Your desire to be consistently successful has to be absolutely immense, overwhelming. He uses this really intense analogy.
Okay.
Imagine someone holding your head underwater. You're running out of air. What's the only thing you want?
Air. The next breath. Nothing else matters.
Exactly. He says your desire for consistency has to be like that desire for air. So powerful that every fiber of your mental being is aligned with achieving it. No internal conflict, no distractions, just pure focus on that goal.
Wow. That's a high bar for desire. Intense.
It highlights the level of commitment needed. Second component, clarity of intent.
Clarity of intent. Meanings.
Meaning you have to be genuinely willing to let go of a certain portion of your identity. Specifically, letting go of those old beliefs and thought patterns that conflict with thinking in probabilities and executing flawlessly.
Like letting go of the belief that you can know what happens next. Or the belief that being wrong is terrible.
Precisely. He uses the Santa Claus analogy. As kids, we totally believe. The belief has energy. As adults, we understand differently, and the belief, the energy attached to it, just dissipates. It's gone.
Ah. So you need to be willing for those old, unhelpful trading beliefs to just dissolve like the Santa belief did.
Exactly. You have to actively intend for that change to happen. Third component.
Let me guess. Sincerity.
You got it. Sincerity. This can't just be lip service. You can't just say you want to change or think in probabilities. The desire and the clarity have to be absolutely real, deep down, authentic.
No faking it till you make it here. It has to be genuine.
Right. And the fourth component ties it all together. Self-discipline.
Okay, but how does he define self-discipline in this context? It's not just forcing yourself, right?
No, his definition is specific. It's about consciously paying attention to your thoughts, your words, and your actions, specifically in relation to your goal of consistency.
Okay, so awareness.
Awareness, yes. And then, crucially, purposefully refocusing yourself whenever you notice you're thinking, saying, or doing something that's inconsistent with that goal.
So it's awareness plus corrective action.
Yeah.
Catching yourself thinking this trade has to work.
Mm-hmm.
And consciously redirecting your thoughts back to probabilities and process.
Exactly that. It's an active, conscious management of your own internal state.
Okay, desire, clarity, sincerity, self-discipline. Makes sense. Does he give any examples of this process in action?
He gives a great personal one, his runner analogy. He decided he wanted to become a runner, aiming to run 5 miles by the end of the summer, starting from being a total slug who couldn't run 2 blocks.
Okay, big goal.
So he created a simple rule for himself, the 5-mile rule. Every time he went out, he just had to run at least 1 step further than the time before.
1 step further. Simple, measurable.
Right. But initially, his mind was flooded with conflicting thoughts. It's too hot, it's too cold, I'm too tired, I'll go after this TV show. All the usual excuses.
The internal resistance.
Totally. But using that self-discipline piece, he just kept consciously refocusing on the goal, ignoring the conflicting thoughts, and following the 1 step further rule.
Pushing through the mental noise.
Yeah. And he said eventually he crossed some kind of threshold. All those conflicting thoughts just disappeared. They weren't there anymore. He didn't have to force himself to run. He actually felt compelled to run. It became part of him.
Wow. So the effort involved shifted.
Completely. He says he had effectively installed a new sense of identity. I am a runner. And once that identity was established, the action, running, became effortless. It flowed naturally from the belief.
That's powerful. So the goal for a trader is the same. Install the belief, I am a consistent winner.
That's exactly the connection he makes. Through desire, clarity, sincerity, and self-disciplined refocusing, you can install that core belief, and the consistent actions will start to flow effortlessly from it.
Okay, so what are the core beliefs that need to be installed? Does he summarize them?
He does. He lays out the 5 fundamental truths about the nature of trading. He says these must become your core functioning beliefs about the market.
All right, let's hear them. The 5 truths.
Okay. Truth number 1, anything can happen.
Anything. Total uncertainty acknowledged.
Okay. Number 2, every moment in the market is unique.
Unique. Meaning past patterns don't guarantee future results because the context is never exactly the same.
Precisely. Number 3, an edge is nothing more than an indication of a higher probability of one thing happening over another.
Just a probability, not a certainty. Got it.
Number 4, there is a random distribution between wins and losses for any given set of variables that define an edge.
The random distribution we talked about. Wins and losses happen randomly within the edge's overall probability.
Yeah.
And number 5, the big one again.
Yeah.
You do not need to know what is going to happen next to produce a consistent income from trading.
Right. Consistency comes from the edge over time, not prediction. Those 5 truths really encapsulate the probabilistic mindset.
They do. And to help make these operational, he offers the Trader's Creed from his book, Trading in the Zone. It's framed as affirmations starting with, I am a consistent winner because.
Okay. Reinforcing that identity. What are the points of the creed?
First, I am a consistent winner because I objectively identify my edges.
Objectively, meaning based on defined criteria, no wishful thinking or rationalizations.
Right. Second, I predefine the risk of every trade.
Know your maximum pain point before you get in. Crucial.
Third, I completely accept the risk or am willing to scale back my position size. Complete acceptance, no internal conflict about the potential loss once you're in.
Okay.
Fourth, I act on my edges without reservation or hesitation.
Just execute the plan. No freezing, no second guessing when the signal appears.
Exactly. And fifth, I continually monitor my susceptibility to making trading errors.
Constant self-awareness. Watching for those fear-based mistakes creeping back in.
Yep. Those 5 points in the creed are like a practical checklist for living the 5 truths.
That's a really useful framework. Okay, truths, creed.
Yeah?
So this gives a great mental map. But how do you actually practice this? How do you bridge the gap between understanding it and doing it?
Great question. And Douglas provides a very specific training exercise designed to do exactly that, to force the confrontation with your old beliefs.
Okay, I'm ready. What's the exercise?
All right. Step 1. Define your edge using strictly mechanical black and white criteria. Absolute no subjective judgment allowed. If this, then that. Super rigid.
Okay, pure mechanical mode. Got it. Step 2. Absolutely commit to taking the next 20 trades that fit your criteria no matter what. Win, lose, doesn't matter. If the signal shows up, you take the trade.
20 trades in a row. Okay, that's a decent sample size to force consistency.
And before you start, you must calculate your risk per trade and ensure you can genuinely afford to lose on all 20 trades in a row. This might mean trading incredibly small, even 1 share if necessary, to take the financial fear off the table.
Right. Remove the money fear so you can focus purely on the execution fear. Makes sense.
Step 3. You also need a rigid, predefined plan for taking profits. No getting out early just because you're feeling nervous. Use a fixed profit target or a very specific mechanical trailing stop rule. Again, no subjective decisions in flight.
So entry, risk, and exit are all predefined and non-negotiable for these 20 trades.
Exactly. And the whole point of this exercise is to force you to confront those conflicting beliefs head on.
How so?
Imagine you follow the rules and you have 3 losses in a row. Your edge signals another trade. What's your mind going to be screaming?
No way. Don't take it. This isn't working. You'll lose again.
No.
All the fear and doubt.
Precisely. But the rule of the exercise is you take the trade anyway, you follow the plan, you act in alignment with your probabilistic model despite the fear screaming at you.
So you're creating direct experiential evidence that contradicts the fear-based belief.
Yeah.
You're doing the right thing even when it feels wrong.
That's the core of it. You do this over the 20 trades. The goal isn't necessarily to make money during the exercise. The goal is to reach a point where executing your plan, doing what's necessary according to your rules, becomes effortless.
Effortless, meaning the internal conflict just fades away.
Yeah.
Like the runner analogy.
Exactly. When you can see your signal, define your risk, place the trade, and manage it according to your rules without any conflicting thoughts, without any fear or hesitation bubbling up, that's when you know you've genuinely changed your underlying beliefs. You've integrated the probabilistic mindset at a functional level.
Wow. That exercise sounds challenging, but incredibly powerful. It's not really about the market at all, is it? It's about your internal landscape.
Not primarily, no.
It's about deliberately embracing the confrontation, like you said, with your own mind, forcing those conflicting beliefs out into the open and overriding them through consistent action.
Yeah, you're actively rewiring your brain to process market information differently, to accept the uncertainty, accept the random distribution, and focus solely on executing your edge over and over, training yourself to accept that no 2 moments are identical, and consistency comes from process, not prediction.
Okay, this really brings it all together. From understanding the problem of fear, to the solution of probabilities, to a concrete exercise to actually retrain your mind.
Yeah, so we've kind of journeyed through this whole landscape Mark Douglas maps out. It's a pretty profound shift he's advocating for, isn't it?
It really is, moving away from that constant, exhausting, and often useless attempt to predict exactly what happens next on this trade.
Right, the need to be right now.
And moving towards the, I guess, The liberation and the potential consistency that comes from just thinking probabilistically and executing your plan over and over, letting go of needing each trade to work out.
It's like becoming the house, the casino, instead of the gambler hoping for a lucky spin.
Exactly. That's a perfect analogy. The casino doesn't know if the next spin will win or lose, but they know their edge will pay off over thousands of spins. You operate with the odds in your favor over your series of trades, detached from the outcome of any single one. That's the professional mindset.
And the journey to get there, learning this stuff, it feels like it's about more than just trading, doesn't it?
Oh, absolutely. It's fundamentally about mastering your own mind, understanding your beliefs, aligning your intentions. When that desire, clarity, and sincerity really line up, like Douglas described,
Change happens, maybe even automatically, like with his running.
yeah, it becomes less about forcing and more about flowing from who you've become.
So maybe a final thought to leave everyone with, building on this. If Douglas is right, if every single moment in the market and maybe in life is truly unique,
Unique.
and if our minds are naturally wired to connect this unique present moment to all our past experiences, our past pains, fears, successes,
Which they are, pattern matching machines.
then the question becomes, what unexamined beliefs, what connections to the past are shaping your perception of reality right now? What possibilities are you maybe not even seeing because your mind is filtering the unique present through the lens of the past?
That's a deep question. What filters are we looking through without even realizing it? And how does that limit what we think is possible in trading or anywhere else?
Something to chew on.
Definitely.
Well, thank you for joining us on this deep dive into the trader's mind. We really hope these insights from Mark Douglas help you, wherever you might be applying them, in your own pursuit of consistency and maybe a bit more mental mastery.
Yeah, fascinating stuff. Thanks for listening.